Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking.
No.
Okay.
Not recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Mm. So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a...
Demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have really a big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems. Will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S. And where else in the world do you find the best and most important technology companies? They're all basically in America.
They're all here. I mean, it's amazing to me that Nvidia alone, folks, Nvidia by itself is worth 50% more than the entire German DAX index of stocks combined.
Yes.
The 30 biggest companies in Germany, or 33, however many are in the DAX, combined are half the size of Nvidia.
Yeah.
Because we have liquid capital markets. We have American ingenuity. We have an amazing workforce. 25% of company founders, by the way, are not born here because we allow a lot of immigration. It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
global recession.
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
Yeah, and you wonder, by the way, this is a little bit off topic, but I saw some huge bets being placed. And there was a note today, and you forgive me, senior moment, I can't remember exactly who put it out there, but that there was a huge bet placed in the interest rate market that the 10-year would be at 2.25% by like next March. That there'd be this massive decline in yields, either because of the Fed, recession, whatever. You have a take on that?
I mean, that obviously is a very cheap bet because I'm sure the skew is for higher rates, not lower.
So it's like a high, high risk but high reward bet.
Yeah.
Not high risk because you're not betting a lot of money, but the odds are you're going to lose your money.
Yeah, it's like a black swan kind of trade. I think it's possible because, inflation internals are collapsing. I think the headline core CPI, and we'll get Friday's PCE, they're being propped up by housing and auto insurance, which are two components, but the rest of the CPI index, 55% of the CPI basket is below pre-pandemic inflation rates now. It's the highest in 4 years. The 20-year average
Yeah.
is 50%. So inflation is tanking.
Alright guys, this is the part of the video where I'm going to break down the stocks that were mentioned on the CNBC clip. Today they talked about the S&P 500 nearly tripling by 2030, and they also talked about Nvidia. So we'll briefly break down both of those stocks. If this is your first video, the blue line is the 45-day moving average and the green line is the 200-day moving average. Right off the bat, you can see we've been on a textbook bull run ever since April, with higher highs and higher lows, nice pullbacks right to that 45-day moving average. As of right now, I caution a pullback, guys. I think we're going to be in the sideways consolidation, maybe even a pullback to this 45-day moving average. We would have support right here at this 530 level from this resistance, and we'd also have support from this 45-day moving average, which we've come back and touched multiple times and respected. Another indicator that we could have a pullback is how far we are from the 200-day moving average. We're almost an 11% drop from the 200-day moving average, and as it appears, it's not catching up as fast as the 45-day moving average. It even seems to be getting farther by the day. So that does make me cautious on seeing new highs very soon. As of right now, we're still bullish. If we hold this 542 area and keep going higher and break out to new all-time highs, then we're still on the bull run. If we do start closing below this 542, I think we're on our way to close this gap and then most likely back to this 45-day moving average. But guys, remember, these are all just very short-term pullbacks. They're predicting over the next 6 years for the S&P 500 to almost triple. We're at 550 right now. He's thinking it's going to go to 1,500. So we have a massive amount of room to run. But everybody's starting to sound pretty sure that the rest of this decade is going to be full of growth from AI. So now on to Nvidia, everybody's favorite darling. In the last few weeks, we've started a pullback, which we hadn't had in months and months before that. We had just rocket shipped higher. So this is healthy, guys. We were getting so far away from the 45-day moving average. Remember, when we were up here at 140, look how big of a distance that is from that 45-day moving average, and even bigger from the 200-day. Even though this is a very sharp, nasty pullback with high percentage, this is still healthy. This is not ending the uptrend. What I'm seeing right now is a leg down, a cooling off period, and I think we're going to have an equal leg down. I think we're going to come back to almost 110, which will meet that 45-day moving average at the very least, guys. And if we can't hold that, we start consolidating sideways and then drop down below, we could come back down to the 100, the 97 area where this is support. Now, in my opinion, that would take some external factors from the stock. We'd need some pretty bad news to get all the way back down to the 100s. But the 110, guys, is definitely possible. We could get there in just a couple days. But guys, we really need Nvidia to stay above 118. If we start closing days below 118, that confirms that we did not make it back to the high and we are losing momentum and we should keep going a little lower. On the other hand, if we do hold 118 and we reject going lower, we start consolidating down here and then making a breakout pattern back to the upside, that could look bullish. But as of right now, I caution a pullback, guys. I think we're on our way down. Those are just my thoughts and opinions. I hope you guys enjoyed the video and the breakdown. Make sure and hit that like button and subscribe if you haven't already, and I'll catch you in the next video. Peace.